Joining us now, J.P. Morgan Asset Management's Phil Camporelli and Oppenheimer Asset Management's John Stoltzfus. Good morning to you both. I'm just looking at some notes here. It seems like we have a little bit of a bull-bear debate that we're gonna be plotting out. So, Phil, I'll start with you. Your take on equities right now, given all of these macro cross currents that we've been talking about day in and day out.
Yeah, so Morgan, good to be here. We'll start with the good news. Yanks won last night, so that's good.
I know.
The other piece of good news, Morgan, is that we're going into CPI tomorrow, which you mentioned, in a much, much healthier technical position. What do I mean by that? The 10-year note before the last CPI number was at 3.30. It's at 4% now. But the S&P was 12% higher. It was surging into that number because people thought that we were going to have some sort of abatement. Now, that's the good news. So we may see a little bit of a rally, but we don't think you can sustain a rally here because the Fed's open mouth operations are not changing anytime soon. They have zero tolerance for the equity market rallying, for financial conditions easing when they're so far away from their target of 2%. So, Morgan, even if we get a good number, what are we going to get? 8%, 7.9 or so? Way too far away for the Fed to be comfortable, which keeps them swinging the sledgehammer of all these gigantic interest rate hikes, which keeps us underweight stocks right now.
So to put a sharper point on it, you think we have further to fall?
Yeah, we think that the lows have not been put in yet. But technically, again, Morgan, you could see a relief rally over the next couple of days because of how we're at the year-to-date lows, Morgan, going into this number. So it would take a huge, huge number to the upside to make stocks fall even further.
John, your thoughts? You've got a pretty ambitious price target for the end of the year.
Yeah, I think our price target likely has to be revisited based on what the bears have done to the level of the S&P 500 over the last few weeks. We'll say this, that we do think that this is not uncommon what we're seeing in a Fed funds hike cycle. We've got a situation where essentially we had overstimulation of the economy, as we all know, by both politicians and by the Federal Reserve. Fed was, behind the yield curve for a long time, now is catching up. We think that the selling looks way overdone at this point. We think that earnings, we've just heard some of the good news related to earnings this morning that was mentioned. I heard Carl going through some numbers a little bit earlier. When you get that type of a picture, the thing is businesses are becoming more accustomed to operating under adversity. Technology enables them to be much more efficient. And if you look at the market today, we've got a nice rally moving here. I don't know if it'll hold through the end of the day. There's still enough catalysts out there for bears to feel like they can sell without FOMO or fear of missing out. But we can't help but think that overall stocks are on sale. And what the market has shown us in terms of the S&P 500 in particular has been a preference for growthier value and garpier growth. Which essentially means companies that are profitable, that have the capability to maintain that profitability, cash flow, and ideally pay dividends. So you can't be willy-nilly jumping into the market here. But for intermediate to long-term investors, this looks like stocks are on sale, opportunities here to dollar cost average, and to do some rebalancing here.
Okay. And of course, as you're talking, the Nasdaq slipping into negative territory. You don't think earnings need to come down, earnings expectations, John?
I think they already have. When you listen to analysts, they're beginning to cut. They're cutting ahead of the earnings season, which is not uncommon during periods like this. Makes all the sense in the world. I think expectations were a little bit too optimistic, and I think that as they come back towards reality, where we're headed to is an opportunity to find that. Going out further, if your goal is beyond, if you're a trader, listen, this is anything goes. And on a day-to-day, the rebalancings and rotations, the buy the dip mentality, the sell the dip, whatever you have, keeps running through. But for intermediate to longer-term investors, this actually is a period that when we look back, people will probably say, gee, I'm glad I participated or didn't get out of the market, or we'll say, gee, I wish I had participated. History
you agree with that?
John, I think ultimately, yes, that's the case. But you have to get to the point, Morgan, where the Fed does a cost-benefit analysis, where the cost of all of these rate hikes do not outweigh the benefit of them trying to slow down inflation and the damage that they're doing on the economy. If you listen to all the speakers from Jackson Hole all the way to now, that is not what they're saying. So ultimately, yes, the American Association of Institutional Investors is at its most bearish point since March of '09. That's a problem. That's a good technical backdrop, but not Morgan right now because of how far away they are from target, and they want to just keep rates high for longer, not low for longer.
Okay.
And that's through 2020.
So quickly then, given your thesis, where are you putting money to work right now?
Yeah, a couple of things. One is still the U.S. over the rest of the world. We talked a little bit about that. We're underweight all three regions. However, the U.S. is our highest allocation in the portfolio. And then, Morgan, I hate to say it, but it's cash. So cash is a really, really good asset class that we haven't had to look at since 2008, yielding over 4%. As the smoke clears, as we figure out where the terminal rate ends, cash is a nice asset class for us, and then some long duration fixed income as well, just to play defense.
Okay, we're going to leave the conversation there. Phil and John, thanks for joining us to kick off the hour.
Thanks, Marty.
As we head to a break, here's our roadmap for the rest of the hour.